Welcome everyone. We're just waiting everyone to come in from the waiting room and we'll start soon. Grab yourself a cup of tea, nice glass of wine, and I'll be jealous and we'll start soon. Okay, nearly everyone's there. There's a few housekeeping things, so we'll just let a few more people come through from the waiting room, but we will make a start. Welcome to our retirement planning webinar. My name's Paul Lynch and I'm the National Relationship Manager with the Australian Catholic Super and Retirement Fund. Tonight we'll be going through all the things that we think you need to know in terms of what you should consider for retirement planning. Tonight we have our financial planner from our Brisbane office, Tom Rouse.
Evening, Paul.
Welcome, Tom.
Thank you.
So tonight's webinar, we're just going to basically go through a few things that we think that you should consider. Just in terms of a few housekeeping, I'll come to those in a moment, but let's just start with an acknowledgement of country. I would like to acknowledge the traditional custodians of the land on which I work and live, and recognise their continuing connection to land, water and community. I pay respect to elders past, present and emerging. Thank you. So tonight's webinar, we're going to be doing as with all financial services company, we must start with our legalities and go through a disclaimer. I always say that if you can actually read the wordings on this disclaimer, you're probably not ready for retirement, your eyesight's too good. But the one thing that I would say is that there is a product disclosure statement that you should read. It is available on our website. But tonight's webinar is essentially a factual information. We do not take into account your personal circumstances in this webinar, and therefore it does not constitute financial planning or financial advice. Tom, a financial planner, will be following, going in the session today. Also applies to this disclaimer in the sense that we can only provide you with just factual information. Today's session, if you do wish to ask questions, what we've done is that we've, so that there's no background noise, you are on mute, but I would say is that if you've got any questions, we will be keeping an eye on the Q&A facility. So I don't know about your settings, but my Q&A facility is down the bottom of my screen. You can chat there or send a question through the Q&A section. Don't use the chat, but use the Q&A section and we'll be able to answer your questions, and we'll come to those at the end of tonight's session. Also in tonight's information, all of the information is contained there on their website, and I do encourage you to have a review of the product disclosure statement. So Tom, whilst you're adjusting your chair or adjusting your monitor, I see you moving up and down there, a bit concerning. I suppose what we've got to look at tonight is about retirement planning. What are your goals for retirement is always the question that we ask people, and that really does stipulate what you need to spend. There are a lot of people out there that have many different plans, and they all do. I suppose the difference is really the cost. So Tom, what do you consider, or what do you converse with clients in terms of retirement goals and how they fund them?
Yeah, so I guess whenever we're planning for retirement, Paul, it always comes back to the goals. What do you want to achieve? So for some people, that's a lifestyle. They want to have the money to be able to do the travel. I mean, not that we've been able to do a lot of it recently, or go on those cruises. For others, it might be, well, I want to retire as early as possible and spend time with the family. So we convert those back to what we call financial goals, but we always look at, well, what are the goals that we want to achieve? And then, okay, what's the best way that we can achieve them? So that's what we talk a lot of time about, take a lot of time talking about when we first meet clients. For sure. I suppose that comes down to a lot of people ask, well, what sort of an income do you think I'd need? So it also comes down to, well, we do have a study that we can provide you with. I always tell people that if they want any information in regards to this, I always Google ASFA retirement standard, that ASFA, ASFA, it's a superannuation body, and they conduct research every quarter on what people are currently spending in retirement. In regards to your slide, I suppose from the left, working from the left, if you're entitled to full age pension, and later in the session that we're going to go through is that all of the criteria that you get assessed to get pension,
but that is the basic full age pension for a retiree at the moment. Now you can see there, the next or the middle box is what the study conducts as a modest lifestyle. So modest lifestyle, you can see there's a few grand. I always say about $4,000 more. And then we move into the comfortable status. So I suppose, without stating the obvious, Tom, can you go through some of the criteria on how they look at this study, what's the differences are, and then possibly what sort of a capital would you need to fund that comfortable lifestyle?
Yeah, but I guess the first thing as well to remember, Paul, with these figures is that they're assuming that you own your own home. So it's important to know that, well, if you are renting, you've actually got to add that rental cost on to the cost of living in retirement. So going back to the modest lifestyle, I mean, that's basically just a very basic lifestyle. You still have your basic private health insurance in there, and you could probably go on a weekend away locally in Australia for your holiday. Whereas the more comfortable lifestyle, that's where you can eat out a bit more, do a bit more shopping. You've got your top health cover in that comfortable lifestyle, and you're going on a good 2-week holiday each year as well. All I would say with any budget, which is the most boring thing in the world to do, but it's probably the most important going into retirement, you need to look at what you want. So the clients that I see, everybody's different. Some people look at that modest lifestyle and they go, that's great, as long as I can maintain that, that will do me. Others who have been used to a bit more income and they want to maintain that lifestyle and they want to go on those holidays and trips, then maybe that comfortable lifestyle, they might need $70,000 or $80,000 a year. That's not unusual. So don't feel because, well, you're spending more than the comfortable lifestyle that you're doing anything wrong. You just got to plan for it. How are we going to achieve that?
Tom, what irks me is that everyone, you see an article in the paper and saying that you need $1 million to retire comfortably.
Yes.
Can you go through the costs or
Sorry, you did ask me before, Paul, so thanks for reminding me.
Thought I'd plug it in there.
So I guess with the modest lifestyle, the best thing to remember is, well, most of that's going to be covered by the full age pension. So the difference there, as Paul's already mentioned, is only $3,000 for a single and about $4,000 for a couple. So you don't need actually a lot of capital to top up the age pension for a good 20, 30 years. The comfortable lifestyle is where we need to have a look. Okay, well, we need additional capital to, I guess, top up any age pension entitlements and provide that comfortable lifestyle. Again, it depends upon when you retire, how long you want the money to last, what risk are you taking with your money. So there's a lot of assumptions, but generally speaking, for a single person who retires at 65 and they want their money to last till 90 for that comfortable lifestyle, you're looking at about just over $500,000. And then for a couple, you're looking at about $650,000 combined as a kind of lump sum that would enable you to generate enough interest to kind of top up any age pension entitlements. But ultimately, the more that you can save for your retirement, the better, because it just gives you more options.
And I think the other thing is that you often hear, or you hear people make the comment that, well, I'm not going to be accumulating that sort of money, so and give up. But I suppose the example I always use is that you mentioned it before. I always say that, look, there's probably about $4,000 difference between a full age pension and a modest lifestyle. If you're living in retirement for 30 years and need $4,000 a year to top up to get to the amount, you're looking at a capital of 120,000. That's assuming no interest. It's a very simplistic example, I know. But it might mean that tonight, well, if you've only got $100,000 in super, that by tweaking it a little bit, gets you to that $120,000 component, might get you a little bit more. So I tell people, if you haven't accumulated, it's never too late. It just might mean a few thousand difference by the time between now and retirement can make a substantial difference into your retirement.
Yeah, exactly right, Paul.
I suppose if you wanted the detailed listings of this ASFA retirement standard, we won't go through those. Tom's mentioned the subtle differences, but if you wanted to have a look at the full details, you can even download the long version and go through all of the different items, what people are spending in different capital cities. It's about an 80-page document. But if you Google ASFA retirement standard in Google, it should be one of the first ones there. but the web address there is contained in that slide. I suppose, Tom, that we talk about saving for retirement, investment structures and the like. Where do we look at funding the most for our retirement?
Yeah, very good question. So again, when people come to see me, Paul, I guess the first thing they think of is I only deal with super. As a financial planner, we actually take what we call an holistic view. Let's have a look at all the assets that you've got to be able to fund your retirement. For most people, though, I guess, look, super, obviously, because it's compulsory for most people, is going to be one of the major assets, along with the age pension, which we'll talk about later for funding retirement. But you might obviously have cash in the bank. You might have inherited shares or bought shares over your lifetime. You might have an investment property. And how you structure those investments, especially going into retirement, is very key to making sure that you meet your retirement goals in, I guess, the best way, and also trying to keep things simple in retirement. A lot of the clients that I see, they just want simplicity going into it. They don't want to have to think about all these complicated financial situations. One other thing that we look at as well, it's not for everybody, but the family home, that might be a way to use your assets to help fund your retirement. Anybody who's heard one of these seminars before, and you've heard it many times, Paul, I always talk about my mother-in-law. She often pops up a little bit, but that was her plan. So she didn't have a lot of super, but she had the home in Sydney, which she owned, and effectively she downsized or moved from Sydney to Queensland, had some money left over to top up her super, because it was more important to her to have more liquid assets to enjoy retirement and do the things that she wants to do. As I say, not for everybody, because a lot of people want to leave the family home as an asset for the estate, but it is something that we do consider to help people plan.
Lovely, thanks, Tom. And look, you've even broken the 10-minute mark this time tonight on mentioning your mother-in-law and using her as a classic example. So well done.
You'll come up many times.
Yeah, I know. I've sat through some of these retirement planning webinars, so I know that she gets raised a few times. I hope she's never attended one of these sessions, Tom. That's all I can say. I suppose when you have a look at the vehicle that you invest in for your savings, superannuation is a very effective concessionally taxed vehicle. So did you want to explain, like, holding your money in your own name as opposed to super, and then I suppose what our colleague calls the tax nirvana of retirement and using account-based pensions? Yeah.
So I guess, again, the first time that I see clients with planning, the main thing I try and get across to clients is that super is not an investment. All super is a tax vehicle for investing. So clients often think, well, it's like an investment property, it's like shares. No. Effectively, as you've already pointed out, the whole purpose of super is it's very concessionally taxed. Money going into super, we'll talk about salary sacrifice later on. The interest that you earn in super is only taxed at 15%, which for most people during their working lives is a lot less than what we call marginal tax rates. And then ultimately, as you've already said, once you're retired and you're over 60, then any interest that you earn on your super in what we call an account-based pension product is tax-free. So all super is a tax vehicle. Once your money is in super, then you choose, okay, where are we investing? Are we investing in property, shares, cash, term deposits, a mixture of everything? But that's why for anybody really 55 plus, this is one of the key investment strategies to make sure they're maximizing their retirement savings. The catch with super is always access. When can I get the money? So for most people, that's 60 plus, and there's conditions of release, which we'll talk about. So when you're young, that's why you probably don't think about putting a lot of money into super, because, well, I can't touch it for 20, 30 years. But as you're approaching that 60 barrier, well, you've got the downside of access is going or gone. So you've got all the upside of using super as a tax vehicle.
Lovely, thanks, Tom. Just remind people that the Q&A, if you've got any questions, I know there's one sitting there already. We'll come back to that question though. But certainly if you've got any questions, use the Q&A facility. I suppose, Tom, if I had $1 for every time I got asked when I when can I access my superannuation fund, I probably would not be doing this webinar with you tonight. I suppose when we look at funding your retirement, I suppose I always say to people, starting from the left, under the current rules, and we are quickly running out of time in regards of accessing it below the age of 60. It won't be too long now until that box will disappear. Essentially, those people born before July 1964, I think it is, have a window of opportunity to gain access to their account if they genuinely retire from the workforce prior to age 60. So they've got to be 58, 59. Once you have signed a statutory declaration that you've genuinely retired from the workforce, you can have access to your account. Now, we've spoken about retirement and retirement planning. That might be when you start using an allocated pension plan. It might be that you use a lump sum withdrawal. There are options, but essentially under the present rules, anyone born before July 1964 can genuinely retire from the workforce, providing they've met that age of 58, 59. Once you meet the age of 60, I suppose the general rule, it does slightly make it easier to gain access to your account. Between the ages of 60 and 64, you need to cease an employment arrangement. So we represent a lot of people that work in education. So if they're resigning from a position, now I use the word resigning, they're not just reducing workload, they're not just going from full-time to part-time, they're resigning from a position. They then would have access, or upon resignation, they would have access to their account to do the same, lump sum or start an allocated pension plan or an account-based pension. So you may be deciding to, because you're not signing a declaration that you're genuinely retiring from the workforce, it may be that you're resigning from full-time and deciding to go casual employee. That is a possibility. We need to see a break in employment, we need to see a resignation, and that's all advised by the employer. So that then unlocks your account for your options. I suppose the next age that we look at is the age of 65. And a lot of people don't realise that once you turn 65, your superannuation vehicle is unlocked. Now, we often get people that, are still working older than 65. It's become, very much the growing trend with economics these days, that we're working longer. A lot of these people that can access a tax-free pension and utilise an account-based pension once they've turned 65. They may be wanting to take out a lump sum to eliminate debt while they're still working. So there is a lot of flexibility that you can look at when you've reached a particular age. And I suppose, Tom, that's where I sort of like tell people, well, look, this is where you need to have a look at the options that you're available. So can you run through some of the different options at those different age groups?
Yeah, definitely. I guess, look, just generally speaking with the first age group, 58 to 59, we generally nowadays don't see people access their super at that point. And the reason for that is because there can be tax consequences. And because I guess they're so close to age 60 that they generally hang off to access super at 60, because 60 is the golden age for super where you can access super tax-free, okay? So whether that's in the form of transition to retirement, so that's where you're still working, but you can access a limited amount of superannuation each financial year. And we'll talk about that in another slide. Or if you're retired, you can access super tax-free as lump sums or an income stream, as Paul's already mentioned. And then again, 65 is a key age where if you're still working full-time, that's where you've got full access to your super, like a bank account. So those really two ages, 60 and 65, they're key trigger ages where you go, okay, options are available. What do we want to look at? Do we want to look at what we're doing with our retirement? But those are, I guess, the two key ages where we definitely need to look at planning around superannuation.
There is a question that's just popped up here from Terence.
Mm-hmm.
Can you explain the taxation if you're accessing your super at 59 and let's say that there's only an account balance of, say, $100,000?
Okay, very good question. So if you're under 60 The first thing is you have to be permanently retired and not intend to work again. So you have to sign a declaration to say that. If you later return to work because your circumstances change, well, as long as the intention at the time of retiring, that was your intention, you sign a declaration. Now, under 60, if you take money out as a lump sum, then I think the actual threshold's gone up. I can't remember if it's $215,000 or $220,000 now. I think it might have gone up to $220,000 the 1st of July. But the first $220,000 that you actually draw out of super from what we call the taxable component of your super is tax-free. So any money that you take out as a lump sum up to that threshold under the age of 60 is actually tax-free. If you convert your super to an income stream, it gets a bit more complicated, because then the income payments that you get from that income stream, well, they count as taxable income, but you get a tax offset. So depending upon your other taxable income that you earn will depend upon whether you pay tax or not on those income stream payments. So I guess, Terence, all I would say is if you are looking at accessing super before the age of 60, just be very clear about how you do it. It will depend upon the tax consequences.
And if you've ever drawn money out of super before.
Exactly. So that $200,000 or $220,000 limit, that's across your whole lifetime previously. So I'd have met clients who back in the early 90s, when you could actually access super, because there wasn't preservation rules on certain amounts of super, that they've taken money out, and that would count towards any threshold. So the tax office actually keep a running total of how much you've actually accessed from superannuation under the age of 60.
Yeah, thanks for that, Tom, and thanks for your question, Terence. I suppose why, so we've looked at the vehicle, we've looked at the quick what you need to base it on. I suppose the quick question is that, well, are there still benefits in salary sacrificing? And I explain to people is that, well, when you contribute on a salary sacrifice basis, the money, instead of getting taxed at your marginal rate, gets sent to your superannuation fund and taxed at just 15%. Now you can see this slide here that the average taxpayer that earns $1 over $45,000 gets taxed at 32.5 cents in the dollar for every dollar over that $45,000 threshold. So you can see there that for those dollars that you're earning, if you forego them and place them into your superannuation fund, instead of getting taxed in your hand at 32.5 cents in the dollar, you're getting them sent to your superannuation and only taxed at 15 cents in the dollar. There can potentially be some significant tax savings. So salary sacrifice is still a very critical amount or a critical benefit, but we just need to make sure that it suits you. I've never met anyone that wants to pay more tax than they should. And I suppose the one thing that if you need to assess how much income that you'll be receiving this financial year, because as you can see, that people don't pay tax anything under $18,200. So it needs to be something that you need to assess year in, year out. So Tom, I would imagine that there are people caught in the trap that, oh, well, I'm retiring, or, you know, I'm taking a part, that salary sacrifice might not be appropriate for them.
That's right. You always have to look at the individual circumstance. So as you can see, if your taxable income's low anyway, you don't want to be paying a flat tax of 15% on money that you would have got tax-free cash in hand, because your marginal tax rate is 0. Just going back to though, if you are earning over 45,000, the example I always give, Paul, is that, well, if for $100 over 45,000, if you had that as cash in hand, it's actually $65.50 after the Medicare levy, because they take an extra 2%. So you can have $65.50 cash in hand to go and spend, save, and pay down debt, do what you want with. Or if you say, well, put that $100 into super, because they only take 15% tax, well, you've got $85 in your super fund. Now, the difference between the two, if you look at it as a percentage, it's actually a 30% difference. So and that's a guarantee purely because of the tax differences. So again, the catch is, well, that $85 that you put in the super fund, you can't touch it until you've met that condition of release. And so that's where you have to think, well, if you want to if you want to save for your retirement, can you afford to reduce your take-home pay? But then there are strategies, which I think we're going to talk about in a couple of slides, about, well, you can actually, if you are over 60, access super tax-free as an income stream. So then that allows people to be able to take advantage of this tax benefit through salary sacrifice and still maintain the same level of income overall. So it's definitely a very common strategy that we look at.
Yeah, lovely. Thanks, Tom. All the ways your examples, gotta love them. I suppose the next thing is that, well, okay, there's such a fantastic tax savings that I get from it. Why don't I do a huge amount? Well, unfortunately, the government has thought about that, and they've put limits in. So we talk about concessional contributions here. So concessional contributions are your employer support. So currently 10%. So your salary, your employer must put in 10%. Now, that they may put in an additional contribution as a result of an industrial agreement. You need to speak to your employer about that. But if you add in salary sacrifice, they are all considered under concessional contributions, or they're all considered as concessional contributions. And the limit this financial year from 1 July is 27,500. So it's gone up a little bit. So it gives us the option of making sure that we can salary sacrifice a little bit. Now, obviously, there's unused carry forward provisions, there's additional tax, there's some few conditions on it. So I would recommend people check. But essentially, if your employer is putting in $10,000 a year into superannuation as SG or employer contributions, well, then you're left with $17,500 to salary sacrifice if it's appropriate for you. So that's just how the limit works. So Tom, I would imagine that you'd have a lot of people trying to get up to, because we've spoken about the tax savings that you can get, I'd imagine there'd be a lot of people trying to get right up close to this limit.
Yeah, well, as we've already talked about, it's a guaranteed return on your money. So if you are in those higher tax brackets and you can afford to have reduced take-home pay, then definitely it's one of the primary ways that you can build retirement savings as a guaranteed return through the tax system. So just going back to what is super, all super is a tax vehicle. Just another kind of a short example is I often see clients that might come to me maybe in their 50s and they've been focusing on debt. They want to pay down the debt, which is obviously a good thing to do because we all want to be debt free by the time we retire. But because interest rates are so low, then they haven't focused on, well, maybe building up a bit of super as well and taking advantage of these tax benefits. So I often see clients that might come to me once they have paid down the debt, then they have all this surplus cash flow, which they can put into super. But their problem is they can't get it into super tax effectively because of these limits. So definitely planning and how you do it to take advantage of these limits. Because as we know, the government can change these limits as they have done in the past. I mean, they've kind of set some rules in place, but you never know if they are going to change how these limits are taxed or what the actual limits are.
Lovely, thanks for that. So I suppose that's talking about concessional contributions, which is employer salary sacrifice. There's a limit there. A lot of people think, well, that's it. Okay, but we've got to let people know that there is what we call non-concessional contributions. Now, I'll try and get this one around the right way, Tom. So I suppose this is spare cash that you've got sitting there, maybe an after-tax deduction from your salary. You may have won lotto, or you may have come into an inheritance. These are funds that you're allowed to top up to your account to boost your account. Now, there are limits on those amounts as well. So under 67, you can put in $110,000 a year. You can also put in 2 other years or bring forward 2 other years so that you can put up 330. Remembering this is partners, each can do this. So we're talking about large sums here that can still be put into super. So that 3 years worth may come in advantage if you've won lotto big. And if you do, hopefully you'll give me a call as well, or call into our Brisbane office and give us a cake, Tom. I suppose once you get between the ages of 67 and 74, the door somewhat starts to close on you. For you to be eligible to contribute to super, you need to meet a work test. And the work test is 40 hours over a 30 consecutive day period. You need to meet that test each and every year to be able to make that contribution of up to $110,000 of non-concessional contributions. Essentially, once you hit 75 years of age, the door's closed for non-concessional contributions. You can't put any more in. So I suppose, Tom, it comes down to if there's a sale of an investment property or a sale of an additional home, you've really got to start looking at the timing of what you need to do to get this into super.
100%, Paul. Yeah. So that, again, that's what we talk about often with clients. That if you ever heard the term asset rich, cash poor, so they might not have a lot of super, but they've got an asset in terms of one or two investment properties. The issue with investment properties is you can't just sell off the front room to go on a cruise. You've got to sell the whole thing or keep the whole thing. So otherwise you're on a fixed income from the rent. So this is where if you're wanting to get that money into a tax-free environment in retirement, you've got these limits on how much you can put in. So how you structure it is going to be very important going forward. One caveat, which hopefully will get passed, is that they have proposed to get rid of the work tests next year or from the 1st of July 2022. So just for people who might be over 67 and under 74 at the moment and have money that they previously have outside of super, if that legislation gets passed, then you should be thinking, okay, well, do we want to top up our super funds because we don't have to meet that work test anymore if that legislation goes through?
Yeah, for sure. And I will say, if that legislation goes through, just to reiterate that. I suppose the one thing is that the government did bring in another opportunity for us to have a final chance of putting money into super. So, Tom, would you mind going through just quickly the downsizer provisions?
Yeah, so again, talking about the mother-in-law. So this is where she uses provision to be able to top up her super. So with the provision, you've got to be over 65. There is, again, a proposal to reduce that age to 60 from the 1st of July. Again, it's not legislated yet. So at the moment, you have to be over 65 to use that downsizer contribution. And basically, if you've lived in your own home for more than 10 years, or a home that you've lived in at least part of the time and owned the property for more than 10 years, then any proceeds from the sale of that property, you can put into super up to $300,000 each, if you're a member of a couple, as a way to get money into super under the downsizer provision. Now, the great thing is this downsizer contribution is totally separate to all the other limits that we've talked about. So the non-concessional, the concessional limits, even if you've got $1.6 million in super, or actually 1.7 now, if you're lucky enough to have that much in super, generally speaking, you can't actually add any more money to super from your own money. But this downsizer rule, you can actually still use that downsizer rule. And then the other caveat is that, well, you don't actually have to use the proceeds from the sale of the property to put that money into super. You could use other monies that you might have. So there's an example where we've had a client who downsized, but effectively bought the property at the same value that they sold at, but they had an inheritance that they had outside of super. And because they couldn't get it into super because they didn't meet the work tests, etc., and they were over 67, but we could use a downsizer rule to actually use that money and top up their super. So again, there are ways that you can use these rules to your advantage. So again, that's a key trigger kind of point, Paul, that if you are selling your home and you've been in it more than 10 years and over 65, is there any opportunity here about what we need to do?
I always say to people, if you do need any more information on that, please get in contact with your local regional manager of the fund, and we can certainly help and provide some information on that. Or if you want, you can also get some financial planning advice as well. So thanks, Tom. I suppose there's no such thing as a bad tax rebate or a tax credit, Tom. Spouse contributions, if you've got a spouse that earns under $40,000 of income this financial year, you can make a contribution to your spouse's account and you can gain yourself a tax rebate of up to $500, and I was going to say $450, but it's $540,000, $540.
That's right.
Nice to get a tax rebate of $540,000, but let's go $540. So spouse contributions are also something, it's a little bit of an unknown thing, or I suppose not often used.
No,
But
previously the threshold was a lot lower. Your spouse had to earn less than 13,000. So the government upped that threshold, that if you have a low income earning spouse under 40,000 and you contribute up to $3,000 to their super, then you get a tax offset in the spouse's tax return who's earning the larger amount. So again, it depends upon how much you're earning and if you're paying tax as well, whether you'll actually be able to use that offset. But again, it's something to think about, because when you look at what's the return, or I go back to what's the return on the money, Paul, and that $540 for a $3,000 contribution, that's an 18% return guaranteed. So not many investments that give you that guarantee.
Totally true, totally true. The other thing is that we always recommend that when you get closer towards retirement, if you've got other superannuation accounts out there, is to consolidate them together, bring them together for their, what I call the final place before we go into an account-based pension. So there are some items that you need to consider, like in terms of insurance benefits and the like, but we can certainly help you through those. I suppose we've sort of touched on the subject, but how can we access our super? So we're going to start now talking about, Tom, the options that you can have in retirement. I suppose the wonderful thing is that with people these days, they still have the flexibility and control over their retirement savings, and they have options. Can you take us through what their options are when they do retire?
Yeah, certainly, Paul. So I guess, again, the best way to think about your super once you're retired and you're over 60, it's basically like a bank account. It is invested very differently because you choose the risk that you want to take with the money. So that's the key difference. But you can access money as a lump sum. So if you leave your super there, then you can actually just take a lump sum whenever you want. It'll still accumulate interest. Or if you can convert it to an income stream, that's where called an account-based pension, allocated pension, or income stream. They've got many names. Effectively, that's where you get a regular payment from your super. You can choose to get paid fortnightly, monthly. You can take an annual payment. But basically, you become your employer then, and you pay yourself. And ultimately, I guess you're accumulating your super throughout your working life, through your contributions. And then generally speaking, you want to convert that to an income stream where you're just replacing the income that you were earning while you were working to have the lifestyle that you want in retirement. The other thing about a pension account, once you're retired, is that if you want to take a lump sum from it, you can. So a lot of clients that I see, they forget that they can actually just dip into it, again, like a bank account. But the key difference between having money in an account-based pension when you're retired or a super account is how the interest that you earn is taxed. So any money in the super phase, we call it, where it's just sitting there and earning interest, you don't actually see this, but the super fund has to pay 15% tax on the interest that you earn, and then they give you your returns. Any money in an account-based pension, well, the interest that you earn on that account, the super fund doesn't pay any tax. So even if you've got the same investment profile within the super and the pension over the long term will always have better returns, and it's purely a tax difference that the super fund isn't paying any tax on the interest that you earn in that pension. Generally speaking, it can be about a 1% difference on the returns. So if you had 5% return in super, it should be around about a 6% return in the pension phase. So that can obviously have a big difference on how long your money's going to last. So that is one of the key reasons why people look at putting money into pension phase. And it's also one of the key reasons why the government have limited how much you can get into pension phase. So there is a limit of 1.7 million. Look, most people not going to have to worry about that. But if it is a problem, it's a nice problem to have, number one. But then you have to plan around that, because the government only allow up to 1.7 million in that pension phase regarding that tax-free status of the interest that you earn.
Lovely. And I suppose we do come across people that are quite happy for it to stay in super. You're not forced to do it, but we always try and make them aware of that. Well, look, there is a tax-free investment vehicle there available and that's what you're potentially missing out on. It does make a difference in the returns. I always tell people, have a look at our investment options on our website and how they differ between the allocated pension plan and the superannuation fund. That is essentially taxation in the differences in the returns. So it certainly can amount to a reasonable amount. Allocated pension plans, Tom.
Yes. So as we've already talked about, you're contributing to super, you're building that up. And once you've reached your preservation age, that lovely age where you can access your super, 58, 59, 60 plus, that's where you can start converting it to that pension. Now, we kind of touched on it before, that when you turn 60, even if you're still working, you can access super through an income stream. It's called transition to retirement. So if you've ever heard that term, what that means is you can actually convert what you've already built up in super into a transition to retirement income stream and draw down a payment. Now, there are limits while you're still working. So the limits are, the minimum is currently 2%, and then the maximum you can draw down is 10%. Now, you can draw that down as a fortnightly payment, monthly payment, annual payment. Now, why would you want to do that? So we look at doing that because, well, number one, if you've got an extra source of income, well, it might then allow you to take advantage of the maximum amount you can put into super as salary sacrifice and save on income tax. So it's a way that you can actually build wealth while maintaining the same level of income. Number two, you could actually pay down debt quicker if that's something that's important to you and you really want to get rid of debt, that you can use those payments to help do that. And then number three, I guess what it was really designed for is actually transition to retirement. So that's where you might be going from full-time down to 3 days a week, but you still want a full-time salary to live on, that you can top up that part-time 3 days a week with a bit of super to make sure that you've got the level of income that you want going forward. So there are many ways that we can use that. Once you're retired or turn 65, then that maximum amount goes. There's no limit on how much you can draw down.
Lovely. There is a couple of questions coming through in the Q&A. I will park one of them and we'll come back to that at the end. The one question that I think that we just need to state is that there's a question from Peter. Can you take the full amount as actual cash rather than remaining in an account? So I suppose you could answer that question is that, well, you can, if you retired, met a condition of release, over 60, you can take out the entire amount as a lump sum at any given point in time.
Yeah, exactly. So you can take it out, go to Vegas, put it on red and see if you can double your money. But yeah, you've got ultimate control. I guess the thing, so once you're retired and you've met your preservation, getting money out, there's no issue. It's getting money back in, there's limits. Okay.
And I suppose the other thing, Tom, is that even if they move from super into pension, there's nothing stopping of closing the account down with a lump sum withdrawal either. No. So again, you've got flexibility. You can do that anytime. Withdrawal, it's just getting money back in. There's age limits, there's amount limits. So you just got to think really carefully about what you're doing. Because again, just going back to if you do withdraw money and say purchase an investment property with it, which you can do, but then you're subject to the individual tax consequences. So capital gains tax liabilities once you sell the property, tax liabilities on rental income, all those sorts of things. Whereas within super, you don't pay any capital gains tax. There's no tax on withdrawals. There's no tax on interest earned in that pension phase. So it just goes back to what is super. All it is a tax vehicle. Thanks, Tom. I note that there is a question there, but we might address that there. We could be able to answer that question when we come up to another slide later on.
Yeah.
I suppose when we're looking about allocated pension plans, we've talked about the vehicle, we've talked about how you get money in, you get money out, generally retire, go on, the list goes on. I suppose next we need to look at, well, what are the investment options once we get them into your super?
Yes. So this is where I guess the two products that Australian Catholic Super offer with regards to those income streams. One's called Retired Choice. So what Retired Choice is it's basically mimicking the superannuation account where you've got the same investment options that you can choose within super. So you can choose a mixture of any of those investment options on your screen right now. You can choose all 13 if you really want. I wouldn't recommend it, but effectively you've got choice. And then that gives you the choice of the level of risk that you're taking. So if you're an ultra high risk taker, you don't care about what happens with the shares, you put everything in shares. Don't see many retirees do that. And then if you're ultra conservative and you don't want to take any risk, you can put it all in cash and term deposits. Generally speaking, I don't like seeing that, because with cash and with interest rates so low, you're pretty much getting nothing, no return on the money. So then you can choose a mixture of, okay, from low risk to high risk, what do we want? You've ultimately got choice of how your money's invested. The other product that the super fund offers is called Retire Smart. Now, this is a bit more of a, well, let the super fund manage my money for me. Okay, let them think about it, and I'll just want to take the payments and live my retirement. So what the Retire Smart product does is uses what we call a 2-bucket strategy. So you've got one bucket, which is a growth bucket, okay? And then the super fund puts 2 years worth of pension payments in what we call a cash bucket. So the way that it works is your pension payments, so you can choose how much you want to get paid. And I think, again, it goes from the minimum of 2% to a maximum of 10% a year that you can choose to get paid. So if you choose a full 10%, they'll put 20% of your money in that cash bucket. Then they pay you that 10% for the 2 financial years. And what happens with the rest of the money, it goes into what we call the growth investment. Now, any interest that money earns or distributions that money earns, that tops up your cash bucket over time. So the theory is that the interest or the dividends that you get from shares or rental income, they top up your cash bucket, which then enables you to provide those pension payments. So that cash bucket is constantly getting topped up. The caveat to this kind of product is what you've got to remember, that you're going to have a lot of assets in the growth investment option. So you've got anything between, well, 80 to 96% potentially in the growth investment options. So the growth investment option is a volatile investment option. It does go up and down. Okay, so that capital, if you put it in that Retire Smart product, you could see quite a large volatility in your capital. Okay, so some retirees don't like that, Paul, which and that's why they tend to go, well, I want more choice and choose the level of risk. So generally speaking, you've got to be a lot more comfortable with risk for that Retire Smart product. So just really think seriously about the overall level of risk that you're taking with that product.
Lovely. Thanks, Tom. I suppose if this was actually a true life seminar where we were sitting down and face to face with people, we'd probably say it's probably time for a cup of tea or retop your glass. But unfortunately, a webinar, we're just going to verge on in. It's nearly dinner time here in Brisbane, and all I can say is I'm smelling dinner, so we'll keep on moving and progressing. I suppose the next thing is we've talked about the vehicles, the options of topping it up. I suppose the big key criteria is that people have a look at what is the age pension and
That's
what
right.
Centrelink look at.
Yeah. So I guess for most clients that I see, Paul, and this goes to 70% of people retiring today, the age pension will form part of their retirement in some aspect. Okay. So planning for the age pension, it can be very key. The way that they obviously look at it, you've got to meet your age pension age. Now, again, going back to my mother-in-law, she thought she could retire at 65 because, well, isn't 65 the age that you can retire? No, depends on the year that you were born. So she was born in February 1954, and her age pension age is actually 66. So she couldn't get any potential age pension until she met that 66. It's going up to 67. And ultimately, it probably will get past it. It will go up to age 70. Probably only if you're born after, I think the legislation that was proposed was 1974. Okay, that they were going to increase it. But you've got to meet that age criteria. Then you obviously have a residency criteria that you've got to be a resident of Australia. And then the way that they assess your eligibility for the age pension depends upon your assets and your income. Now, these are two tests that Centrelink or the government apply separately. So they look at your assets and they go, okay, under the assets test, what are you eligible for? And then they look at your income and they go, okay, under the income test, what are you eligible for? And then they're so kind that they pay you the lower of those two calculations. So it might be, well, under the assets test, you're eligible for something, but under the income test, well, you get $0. So they're going to pay you $0, or vice versa. So if we have a look at the assets test first, with regards, oh, sorry, we got one slide before that.
One slide. So this is, I nearly felt like flicking it through when you were talking. I thought, he's got a few other points to make.
That's all right. So these are the dates, these are the birth dates that you have to look at to say, okay, when am I eligible for the age pension? So anyone, for most people, I guess, who are born, well, for everyone born after the 1st of January 57, it's age 67, okay? So just to remind you there, so if you've already reached 66, you've already attained your age pension age anyway. So getting onto the assets test, so this is where, okay, depending upon whether you're single or a couple, whether you're a homeowner, a non-homeowner, okay, will depend upon, well, how much assets will Centrelink allow us to have before they start reducing the age pension, what they're going to pay us. So as a single homeowner, if you've got assets of under $270,000, so that's not including the home, but it includes everything else. It includes your car, your contents, money in the bank, shares outside of super, the value of your super. Then if that is above $270,000, that's when they start reducing how much you get in age pension. And then ultimately, if you've got $593,000 as a single home owner, then that's where they pay you $0 in age pension above that threshold. If you're $592,000 of assets, you're probably getting $1 worth of age pension, which is what a lot of people kind of want to do. They want to get the pension card. So there are strategies that we look at to reduce assets, and those are more around, well, do you improve the value of your home? There's things like funeral bonds that you can invest in. Not everybody likes to talk about that, but it is something, I guess, that you can look at. And also some lifetime annuities. So different income streams can actually reduce your assets for Centrelink purposes. So there are strategies that if you are just above the threshold, that there are ways to reduce your assets to get below the threshold to get that pension card. So that's as a single homeowner. And then as a couple, effectively the threshold's $405,000. If as soon as you've got money above that, they start reducing the pension as a couple. And then the upper threshold has gone up to $891,000. That if you've got assets above that, then again, you don't get any age pension. Now, the key thing with the couple is not only don't they count the home as an asset, but they also don't count any money in a superannuation account for somebody who's under age pension age. So this is where if you're a member of a couple where, well, one has attained their age pension age and one hasn't, that actually moving money into the spouse's name, where it doesn't count as an asset for Centrelink, can improve the Centrelink benefits for the older spouse. So again, how you structure your assets going into retirement and structure it can really impact, well, what are you eligible for? So we do a lot of planning around that as well, Paul. And I guess the bigger the age gap, the more that you can take advantage of, well, one member getting Centrelink while they're above age pension age and one member not. So definitely something to think about under the assets test. Then the other tests that they provide, so that's one test, and the other test that they look at is the income test. Now, for most people, while they're still working, employment income is going to be the main income that counts towards this test, okay? If you're above age pension age, they don't actually count the first $350 a fortnight that you earn. Anything above $350 a fortnight then gets counted towards this income test, okay? But again, it's just looking at those figures, because if you're a single person and your total income is less than $55,000 a year, whereas a couple, if your income is less than $84,000 a year, then there will be some eligibility there if you're over age pension age. So I often meet couples or singles, Paul, that they think that, well, I'm not entitled to anything because I'm working. They don't care how much you're working. They just want to look at what are you earning. So there's times there where a part age pension, if you're under that threshold, you can apply for. And then the other thing is if your partner's getting an age pension, and this is often what I see as well, that the partner's applied for the age pension, but the other partner hasn't because they're working. Well, if they're getting the age pension, you should be getting exactly the same as your partner because they look at you as a couple, okay? If you're both over age pension age. So again, it's just to remind yourselves to look at your situation and are we missing out on any entitlements that we can claim? And then the amount that they're going to pay you. So this is where we go back to that one of the first slides that we did. The ask for modest and comfortable. So as a single person, it's just over 25,000 a year is the maximum age pension. As a couple, it's just under $19,000 each, so nearly $38,000 as a couple. And then if you're separated due to ill health, then they pay you the single rate. The other thing to remember that if one of you is a member of a couple that's over age pension age and one of you is under, the member of the couple will only get paid the couple rate. They don't get paid the single rate. So that's the other thing to remember with those payments.
Thanks, Tom. The elusive healthcare card.
Yes. So again, all I would say about people who are wanting to qualify for the age pension, don't cut your nose off to spite your face. I mean, you could just go and spend $200,000 and reduce your assets, but then you've lost, depending on how you spend it, you've wasted $200,000. So the main reason why people want to get a dollar's worth of age pension is probably for the health benefits. That's kind of one of the key benefits. Now, the good thing about the Commonwealth Seniors Health Card is it's not asset tested, okay? It's income tested. So for most people who are retired and not working, then I would say 97% of Australia is going to qualify for this card, because the way that they do the income test, they don't actually they don't actually look at what you're taking from your super in terms of a payment. They do something called deeming on your super. So they assume that you're earning income. And because deeming rates are so low, 2.5%, then you've got to have a few $1 million in super as a couple before you're not eligible for this card. So that's why I say for most people, they will be eligible for this, which then gives you the discounts on obviously bulk bill doctors, cheaper medicines, which is what a lot of retirees just want, that security that they don't have to pay for full price for any medication that they might need. There are obviously other state or territory government benefits that you can get. Still not familiar with the Queensland ones, Paul, but I know in Sydney it's often called the gold opal that you want to get with the travel card. But again, just look at what you might be eligible for. That's generally around how often you're working, so how many hours you're working, and meeting an age requirement. So it is something that is important to look at, because I did have a client once that moved to Melbourne, and effectively, if they were on a concession card, whatever it was, they had reduced stamp duty when they bought their property in Melbourne as a retiree. So there are kind of little things that you might not be aware of. So definitely looking at the state's websites is a good thing to just keep an eye on.
Lovely. I suppose every dollar in retirement matters, Tom.
It does, of course.
Estate planning. I suppose the one thing is that we always got to keep an eye on what will happen to our affairs if something was to happen to either us or our partners and the like. So do you want to go through just quickly in how you can help in terms of financial planning?
Yeah, certainly. And I think, yeah, we'll answer that question that popped up as well.
Yes.
Because that was around estate planning from Terence.
Yes.
So look, any solicitor you speak to will always say, once you turn 18, get a will. I don't know how many 18-year-olds actually have a will, but it's important to have a will in place to effectively say how you want your estate assets to go. Also putting powers of attorney in place, that if anything did happen to you, well, who are you going to allow to make financial decisions on your behalf or medical decisions? So obviously that's a very powerful document, but it's very important to have. Generally speaking, you have it for elderly parents, but the thing is you never know when someone might need to use it. So again, get that in place if you haven't. once that's in place, I mean, it's just a document and it's kind of set in stone. And then the final thing that we look at helping around is beneficiaries, so in super. So Terence, your question was, well, what happens to the allocated pension if a pensioner passes away? So there's two options, that if you have a spouse, or actually with Australian Catholic Super, if you have a child with a disability, then they can actually become what we call a reversionary beneficiary. So what that means is the actual pension account doesn't go through your estate. It just reverts to being paid to your spouse or disabled child. Okay, so that can be very powerful because, well, it doesn't have to go through the estate, doesn't go through probate, the payments just continue. And then that spouse or the disabled child can ultimately choose, okay, what do we want to do with that pension? If you don't have a spouse or a disabled child, then what you can do is you can nominate what we call a binding beneficiary or a non-binding beneficiary to say, well, I want this money to be paid as a lump sum to this beneficiary. Now, the good thing is if you put it as binding, again, the super fund will just pay that according to that binding nomination. It cannot be contested. There are limits, though. You can only nominate certain people or entities on that binding nomination. So again, it's a spouse, de facto partner, someone in an interdependent relationship, a child of any age. They don't have to be disabled, so it can be a child of any age, or your estate. So you can actually nominate your estate as the beneficiary as well. So that is a very powerful, so you can nominate that on the account-based pension or your super fund with regards to how you want that money to be passed. The other thing with estate planning is not a lot of people know this, or you don't realise it until you come across it. There's no death taxes in Australia apart from on superannuation that gets passed to a non-tax dependent for beneficiary purposes. So generally speaking, adult children. So if money from super gets passed to adult children and you have what we call a taxable component in your super, then the government actually take up to 17% tax as a flat tax from that taxable component within your super. Okay, so it can be quite a significant chunk. Two things. Number one, it doesn't impact you or your partner or your spouse because it will always go to you or your spouse tax-free. Number two, you might spend all the money anyway before it gets to the kids. That's the plan for most people that I see. But if it is something that concerns you and you want to plan for it, there are strategies to reduce or eliminate or minimise that estate planning tax within super. So it's getting something that's quite common nowadays, Paul, planning for that.
Yeah, it certainly is, and it's got huge ramifications for it. Even just looking through superannuation fund, people when they're signing off nomination of beneficiaries, they often, oh, well, my husband, he's financially stable, I'll just leave the money to the kids. People are unaware of that taxation, that,
yes,
that you can leave it to the husband who can then pass it on to the children, subject to a bit of availability, but there's certainly some implications that you need to have a look at.
Definitely, yeah.
I suppose aged care, Tom, I suppose that's a growing area. It's not only just for individuals, but also parents.
Yep. Yeah. So again, I guess we bring this up, Paul, to remind people that as a financial planner, we can do a lot of planning. So where aged care comes in is actually I speak to, it's usually clients that are retiring and they've got elderly parents and they're going through that process of looking at aged care or having to put them in aged care. Can be very complicated. How do you fund it? Do you sell the home? Do you keep the home? Do you rent the home? Do you put a deposit down on the and what's the cash flow? What's the fees that we're going to have to pay? So this is where we really help with the financial side of things, is putting a plan together to say, okay, well, this is the best structure that if you want to fund aged care in the best way, look at potential estate values to make sure that they're maximised, getting the best care for your parents. How do we do all that? This is where we can help out. So it's just to remind, I guess, our members that we can help in a lot of ways. And this is, as you say, a growing area given the complexity of the rules around aged care.
Thanks, Tom. I was just going to say is that if you've got any questions, send them through. We're coming to the end very quickly. If you've got any questions, you can go through on the Q&A function on the Zoom call, and we'll come back to your questions in a moment if you've got any. I note that there is a couple there already. Tom, can you just go through on what items you can actually, you've probably touched a sprinkling of them all the way through this session tonight. Just quickly wrap up on what you can actually provide as a financial planner.
Yeah, definitely. So I guess the purpose of these seminars is to not only educate you, but to try and, I guess, trigger you to think about, okay, have we got a plan in place? So you might already have a planner, be seeing them, that's great. But this is where if you come and see us, these are the sorts of things that we focus on. Saving more for retirement, having strategies to do that. How do we maximize Centrelink? Okay, looking at if you are concerned about how long your money's going to last, having a plan in place to look at scenarios. So we often look at, okay, well, if we retire earlier, how does that look? If we retire later or work part-time? So giving you a bit more information. We've already touched on those estate planning kind of benefits that we can look at, and also any non-super investments that you might have that you might want to get into super, having a strategy around, well, tax effectively selling them down, limits on how much we can get into super. So just a holistic plan, again, with regards to all these sorts of topics. And when we look at advice, Paul, there's always what we call tangible and intangible benefits to advice. So I think on the next slide that we've got, oh, no, I thought we had one there, but no. So talking about benefits to advice, there's a tangible side of things. So we've saved on tax, we've built the super, we've got more Centrelink. So that's where we can really add value. But we also add value on the intangible side of things, which is more that, well, we've got a plan in place, we've got a blueprint that we can work towards and keep track of. So that's often what a lot of clients like as well, is they just want to be have that safe knowledge that they've got a plan in place that they can follow going into retirement.
Lovely. Thanks for that, Tom. What I will say is that I suppose, would you mind running through the financial advice offerings? I suppose the first thing that I need to say is that if you do need any general information or general advice, you can call our call centre. You can call our regional managers. So if you do want to gain further information from the fund in the basics of your account, looking at the portal, which I'll touch on in a moment, please do not hesitate to give either myself or one of our regional managers a call. I suppose the other thing is that Justin, our assistant in the background, has just placed in a link into the chat facility. So if you want further information from the fund, you can use that link and it can take you through as to which option you would prefer. That is totally up to you. Now, the one thing that I would say is, Tom, would you mind going through the two different services that we have available?
Yep. So for the more personal advice, so that's where you're being given some recommendations. We've got a couple of options. The over the phone advice, so that's a free service that the fund offers, where fully qualified advisors can give you personal advice, but only on specific topics relating to your super. So those the main topics that they look at are the investment choice within your super. So if you're having any questions around that, or looking at any different investment options, contributions to super. So that's quite a popular one, especially with the increase in the cap, if you want to double check and you want to try and get up to that cap because you can afford to do so, the limited advice team can give you some recommendations. How do we make sure we do that? And then the third area is around insurance within your super fund. That if we haven't really touched on it because this is a retirement planning seminar, but if insurance is important, the right levels of insurance, they give you some recommendations on that. So that's the free service, or complimentary services, being a member of the fund. The comprehensive advice service, well, this is where we look at your whole situation. If you're a member of a couple, we always look at you as a couple as well. It's very important. And you don't have to be a member of Australian Catholic Super to get advice, because with this service, it's what we call a fee-for-service model. So the initial appointment, if any of you have gone through it before, we always sit down, usually for about an hour and a half. look at your situation and go, okay, how can we help? So we go, well, in my professional opinion, you need to focus on X, Y, and Z. This is what I would look at as part of a plan. And this is the sort of plan that I would put together. If we can't help you, we would say so. We'd say, well, look, you're doing everything that you really can. There's not much really that we can put together in part of a plan. But if there is, we would explain, well, this is what we can do. These are the benefits. And then we provide what we call a fixed quote for the statement of advice and putting that blueprint together. And that's a fixed quote to basically put the advice together, go through the advice and implement the advice. We don't charge any ongoing fees. I don't get any commissions or bonuses for any advice that I do. So it sounds a bit altruistic, but I got into doing advice because I love to help people, pass on my knowledge, put them in a better position. But ultimately, if we spend time doing that and that the individual is benefiting from that advice, comprehensive, we have to charge for the time it takes. So you get a quote, generally speaking, it can be anything between $1,500 to $2,500, depending upon the complexity of the plan. But you decide whether you want to proceed after that stage to put that plan together.
For sure. I suppose, Tom, there was a question there from Gail. I will arrange for someone to give Gail a call in regards to the timing issue of tonight's webinar. So Gail, someone will give you a call from our office tomorrow in regards to tonight's webinar. Tom, I suppose the thing with comprehensive advice is that people need to, well, I suppose either see face-to-face or, you know, seek some comfort to make sure that they're on track. I always tell people that by coming to meet with you, there's got to be a justifiable benefit in you doing the advice. Can you just go through in terms of the cost structure and how you work with clients to talk about the cost and what benefits that would arise from that?
Yeah, so I guess with regards to the benefits, it comes back to that tangible and intangible benefit that sometimes I can show straight away that, well, you're going to save 10 times the amount that you're going to pay for the advice in tax or interest that's saved on loans. So that's quite an easy, I guess, benefit, because again, it doesn't benefit me what the client does, whether they take advice or they don't. So we just charge for the time it takes for putting that plan together. So that's how we charge for the advice. Then there's the intangible benefit as well, that some people like to pay for the advice because they want that feeling that they know they've got a plan in place and they're on track. So it might not be that we can save them thousands in tax, but they feel it's worth paying for the advice because of the feeling. Now, that's a very individual choice, that some people are happy to pay that fee, some people aren't. All I would say is, going back to the fees, Paul, we're not a profit-making business. We're just a cost recovery business in terms of recovering the costs it takes for the time it takes to put that advice together. So generally speaking, if you get a quote from myself, you can go to another financial planning organisation and get a quote that I think you would find we were very competitive in terms of any plan that we would put together to help members.
Yeah, and I always tell people that they're going to get a strategy blueprint that's, what, 60, 70, 80 pages long sometimes. Yeah. If you wanted to, you can let it lie under the pillow. Absorb it, give you peace of mind knowing that you're on track each and every day if you wanted to.
But we're also, if you do get a plan put together, we don't just give you the plan and say, there you go. We help you. It's all the time it takes to implement any recommendations as well, which would generally be over a 12 or 18 month period. So that's what the cost is covering, is also the time it takes to implement.
Totally agree.
Yeah.
So I suppose after tonight's, there's a link there that it's been placed in the chat. If you wish to partake in that service, someone can give you a call to arrange an appointment time, or otherwise there will be a survey sent out to you after the session tonight. That will also contain an opportunity for you to provide some feedback in terms of tonight's session, but it'll also allow you that if you wanted to gain further information, you can indicate where you would like that, and we'll arrange for someone from the fund office to give them a call pretty soon. So thank you very much for that, Tom. I suppose the thing that we also need to address is the new or the Your Future, Your Super legislation that was recently introduced. I suppose it has a little bit of a history in the sense that it was introduced back in October of 2020. It was legislated only recently, and then the way the test would operate was only provided in early of August. I suppose there has been some significant discussion in regards to the test and the makeup of the test, but we were only notified that our MySuper investment option, the MySuper investment or default option, did not pass this test, and we were only notified on the 30th of August. Essentially, the test is a 7-year test, and what it's done is that it's comparing it to a predetermined benchmark. So we have a lifetime one option that has only been available for the last 3 odd years. And what they've done is brought together and utilised our previous default investment option of being the conservative balanced option. So basically, they've used 2 extremely different products and combined them together to determine our performance on the test. So basically, the combination of these 2 products that we've put together did not pass this mandated test. So we just wanted to make sure that this only applies to the default option. It does not apply to the other 13 investment options that we have in the fund. And to date, we have not been advised of the exact position on the benchmark. The reasons why the underperformance is that certainly our shares investment product has not certainly met the statutory benchmark. Now, that is a historical item. And the irony is that we've always mentioned, and if you've read the disclaimer, I did one of the points there is that past performance is not an indicator to future performance, and yet this test is looking back historically over the last 7 years. So back in 2018, we have restructured our share portfolio to ensure that it's taking the best advantages that are available there for our members. The other item that has led to the detraction or the result is that our alternative investments have been, I suppose, put together at a benchmark and compared together at a benchmark of an asset that's significantly higher in growth orientation, which therefore, if it's got a higher growth orientation, it should have performed a higher amount over a longer period of times. This has certainly negatively impacted the portfolio. We've previously acknowledged our underperformance 6 and 7 years ago, but I can honestly say since with the introduction of Lifetime One, in the last 3 years, we've seen stronger performance, and I'll provide you with some performance figures in a moment. The one thing that I would say, if you want further information in regards to this YFYS test, there we have a dedicated page on our website. The government has provided a MySuper comparison tool. And I would say, Tom, we've both known clients that have looked on that. And we've also seen many people comparing our fund over the 3 years. We acknowledge the fund has had significant underperformance many years ago, 6 and 7 years ago. But we acknowledge that in the last 3 years since Lifetime One has been around, this Lifetime One or product that is now our current default has been very competitive against other superannuation funds. And we would ask and recommend for you to go and compare those. I suppose there are many different viewpoints and there's lots of different articles, and we've placed some of those on that website page as well. In terms of the goals of the product, it's met its intended objectives. For example, members under 40 years of age, my children who are in this product, earned last financial year ending June 30, a return of 20.9% after fees and taxes. Certainly a return that's not highly seen in our lifetime of our investments, whilst we're sitting in a superannuation fund. So Lifetime One basically is high risk for younger members. They have a high growth orientation. Simply and purely, they have a long period of time to retirement. And this life cycle investment, once they hit the age of 40, they gradually reduce down in risk. So it becomes more and more conservative as you get closer towards retirement. And I think that's a wonderful, it's a life cycle product that we say in the industry. And it's certainly one that I find that it's, as humans, we get more and more conservative. And I imagine, Tom, that you've seen people closer to retirement becoming more and more conservative as they age. Getting closer to retirement, they're seeing their size of their account balance, and that's exactly what this product has done. And it's done, certainly done what it was intended to do and designed to do. So you can see there, last financial year, a 40-year-old, the highest risk exposure was 20.88%. As you can see, there's a general reduction in the returns. And what we've done is that each and every year, you've got a very gradual, and I try to emphasize that point, it's a very gradual reduction down in risk. So when you're looking at comparing products, you need to make sure that you're comparing products that are risk appropriate to that age. And so I would refer people to the investment fact sheet that's on our website in regards to the different structures of terms of risk. But you can see there someone who's age 60 in a conservative environment. The return was 13.87 for last financial year, and the 3 years average was 6.55%. So you can see there that the lifetime ones returns has certainly done what it is intended to do. So I suppose our future, the outlook. The trustee has certainly always ensured that we are looking after the members' best financial interests, and they're going to continue to do so. They're going to be, I suppose you could say, acting in the best financial interests of the members by seeking scale. The industry has come together with very large superannuation funds. There's been a lot of mergers of late, and the fund will, in the not too distant future, be announcing a merger partner that will provide us with scale. The government has certainly advised that to survive in the superannuation fund going forward, you need to be of a fund of at least $50 billion. We're certainly looking to be going to a partner that will be in excess of that. That, by way, is going to be looking after the members' best financial interests, is that it will produce scale. It will provide greater benefits to members. With the economies of scale, it could be reducing costs. We've already reduced cost in the past few months, and we will be reducing indirect investment costs soon. So certainly, if you've got any questions in regards to the fund, I'd ask you to reach out to your dedicated regional manager, and they can provide you with further information in regards to this performance test. I'd also encourage you to go and have a look at that super comparison tool and do a comparison on the fund, and have a look at that and have a look at that 3-year performance figure. I suppose the other options that we do provide is that we can have a look at the upcoming webinars. Now, we do a quarterly investment webinar, and I would imagine the one would be coming up in the next month. And these are all listed on our website. So just like you've registered for tonight's webinar, there are certainly a number of webinars that you can do, you can look at to register to gain some more information. I suppose the other thing is that if you want to get some further information, as I mentioned, there's the link for there, but there's also the survey form. If you've got any questions, we can certainly give you a call. I suppose the people that have asked some questions, I'm going to ask your local regional manager to reach out to make sure that all of your questions have been answered tonight. I suppose the other item that I tell people to look at is the portal. A little bit small in font size. I'm pleased I've got my glasses on to read these, but I suppose the member portal is an excellent place where you can have a look at your account. You can do a number of items there. You can make a contribution. Obviously, you can see your account balance like this person has. You can change your investment options. The really wonderful thing is that in the middle there, you've got manage my insurances. As Tom mentioned, it's a retirement planning webinar tonight. But if you want to just have a look at your insurance arrangements, you can even get a quote for increasing them. So certainly I would encourage you to do that. You can also nominate, but it's a non-binding beneficiary. That is certainly available. The other item is that in the top right-hand picture of the slides, it's got a retirement projection. So if you're wanting to have a look at how your account is tracking towards retirement, that is certainly a good tool that you can utilise. It's a planning tool that we've provided based on your account balance as at today, based on your contributions over the last 12 months. And we can do some planning as to where your account, or we believe your account, will go to in accordance with your chosen risk profile. Now, there's a bit of terminology there, risk profile. I would also recommend that if you do not know what sort of an investor you are, we also have a wonderful tool on our website called the Risk Profile Calculator, that it can provide you with some guidance as to your chosen investment items. So certainly the member portal and the website, there's a lot of resources there. I would certainly recommend that you have a look at that. And I must admit, and I've only recently downloaded it, is the app. The app is back. And I must admit, you're shaking your head there, Tom, but I'm
nodding. I had a client actually ask me yesterday, when is the app back? And I just found out that it's just come back on in the last few weeks, I think.
It has come back in the last few weeks. So you can download that from the App Store and go into your account just like you would your member portal. So realistically, if you're carrying your phone anywhere, if you really wanted to know, I would encourage and say probably you shouldn't. But if you really wanted to know, if you're out and about, you can click on the app and it does some wonderful things. So I'd certainly encourage you to have a look at that. I suppose if you've got any further information from tonight, as I've mentioned, there's the survey. That will be sent out to you. You can certainly ask any questions there and we'll arrange for someone to give you a call. Tom, I suppose the one question I have for you before we go, there's a couple of questions there and we might park those and because we're running out of time very quickly. Retirement planning is all very complicated. I suppose there are a number of different options. You might be 1 year out, 2 years out. I suppose the question I always hear is, when should I seek advice? Is it right at the last minute, a year out, 5 years out?
The first thing is it's never too late. So often people think, well, it's too late, I won't bother. Never too late, even if it's just a year out, 6 months out, there's things that we can do. But obviously the earlier the better. And I've never had anybody say, oh, I shouldn't have come. They always say I should have come earlier. So obviously the earlier the better that you plan, that you've got a plan in place. But I would always say as well, it's never too late. Don't be put off if you think it's too late, because it's not.
Lovely. Thanks, Tom. Look, in the interests of people, I would imagine that if they had a glass of wine over the hour and a half, that's maybe we've had one or two. Dinner is calling us here in Brisbane, or Sunshine Coast for you. So thank you, Tom, for your presentation tonight. It's been valuable. I'd also like to thank Justin Colley, our colleague in Sydney office, who's in the background helping us out. So thank you, Justin, for your time. I note that it's 8:30 for you, so I would imagine that it will be getting to the point of getting the book and going to bed soon. Need to be bright and early for the next working day. I'd also like to thank you all for attending tonight's session. Thank you very much. It was greatly appreciated. If you've got any questions, you've certainly got our numbers there, the 1300 number, and the local regional manager will certainly get in contact with you if you've got any further questions. Again, thank you very much for attending and have a good night. Thank you.
Thanks, Paul.
Thanks,
Paul.
Tom.